Hello and welcome to another episode on Classroom. These past few weeks has seen a lot by way of money coming into the market, but it's come in an interesting route. It's called QIP, so Qualified Institutional Placement. What does it mean? How is it done? What is it used for? And why does this method benefit a company that's looking to raise cash or needs cash versus any other method? Two very special guests joining in to talk about that. Praveen Sood, CFO of Hindustan Construction. They have just concluded a QIP of their own. And Chetan Savla, Executive Director at Kotak Investment Banking. Gentlemen, good to have both of you on the show. Praveen, we always start with definitions. Let me kick it off with you. How would you define a QIP, one that you've just concluded?
Yeah, if you look at the QIP basically is a short form of the Qualified Institutional Placement. When the issue is placed to a set of investors who was basically listed with the SEBI and they have been, as per the guidelines given by the SEBI, belongs to a certain class of investors, and with the placement is made only to those people, it is called as the Qualified Institutional Placement, and it's basically being made to the a set of investors called QIB, Qualified Institutional Buyers. So this is to a specific set of the investor who has the expertise to how to invest. They knows the market, they knows the people who are into this thing, and basically it's meant to an expert class of investors.
Just to compare this against other fundraising methods, Praveen, I mean, you could have done, say, a follow-on public offer. You could have gone the GDR route. Of course, at one point of time, FCCBs were very fashionable. They aren't anymore. Why does a QIP get a plus for you versus these other modes?
If you look at the history of the QIP, why it has been brought about, you will come to know the difference. QIP was brought about somewhere somewhere around May 2006, when it was found that most of the Indian domestic companies are basically going overseas to tap large investors. So it was thought, in fact, if all the domestic companies start going overseas and so what about the local investors? So it was the QIP guidelines came in, and it was basically more or less similar to the GDR guidelines and the FCCB guidelines, where they make sure that a class of investors has been created and they have been allowed to participate in this kind of offers. And as far as advantages of this class of investment over FCCBs and GDR of follow-on offer or the IPOs or the right issues is that, first of all, especially it's very, very time efficient. It can happen as a flat 5 to 6 weeks. In fact, if you look at the QIP which we have done, it just takes about 5.5 weeks to be exact. And second thing is that obviously it's very, very cost efficient also, because in case of an IPO or in case of a follow-on public offer or in case of a right issue, the amount of money which you spend on various issues is much more than what you issue in the QIP.
Chetan, how would you define a QIP, and what would you mark out as the positive aspects of this fundraising option versus doing something else for a company?
To answer this question, I'd like to go back a little in history before the QIP guidelines were announced. And the only way in which a listed company could raise equity capital without doing a public issue was through GDRs. The advantage that listed companies saw in doing GDRs was that it was a quick process. It was much shorter than doing a full-fledged public offering. Secondly, it involved only institutional investors, whereby it was not necessary to give significantly large discounts on pricing as would have been necessary to give to retail investors in the case of a public issue. And third, the process was very short in terms of timeline. Anywhere between 5 to 6 weeks was all it would take to do a GDR issuance. Now the reason why companies were going to do GDRs is because a similar process was not available in India. What the QIP route has done is that it has offered a similar route in India, which is actually simpler than a GDR, because you don't need a prior SEBI or a stock exchange approval on the stock exchange. And you can go to a wider set of investors. In the case of GDRs, you can go to foreign investors only, whereas in the case of QIP, you can also go to Indian mutual funds, Indian banks, Indian insurance companies. So a much wider set of institutional investors who are participating in qualified institutional placements in India. From start to finish, in my experience, the fastest transaction that I have done is from the board approval date of a QIP to the day the QIP was closed in 30 days. That's the kind of speed that can be achieved in a QIP, and therefore it's quick to market for a listed company. So it's much better as compared to other sources.
Is it open just to a few